Welcome, everybody. I apologize for interrupting your summer vacation, but we have to learn how to trade the open with Sami Abusaad. So, Sami, how are you doing today?
Doing great. Doing
Awesome.
great.
Awesome. All right. So this is a hot topic that everybody loves to learn because the open is the most exciting part of the day. It's when there are the most opportunities. So we brought in the master of it, Sami Abusaad, to show us how it is done. So please give us your undivided attention. Find a quiet place without distraction. Shut down other windows and apps. Put out the dog. Put your kids to sleep. Throw your phone in the garbage. Don't even turn it off. Just throw it out altogether. That's how important this is. And you could see Sami smiling. Sami knows this is the truth. And stick around because there will be a special offer for everybody who stays until the end. So a little bit about Sami. So Sami's been a pro trader since 2007. He runs our strategic swing trader and day trader programs, our mentorship program. He's a core day and swing trader, gaps, climactics, earnings, everything. Sami does it all. And fun fact, Sami is a former certified public accountant. And he decided that wasn't exciting enough, so he had to come into the fun world of trading. And Sami is also an amazing teacher. Traders have paid up to $5,000 to work with Sami. They've come to the U.S. from Argentina, Canada, Colombia, Germany, Hong Kong, India, Israel, Italy, Spain, other countries, and all over the United States. They've traveled to work with Sami. And today you have the chance to learn from him for free. So, Sami, thank you for being with us on this wonderful Thursday afternoon.
I am happy to be with you all. Hi, everybody. So today I have a special presentation for you. I am going to talk about truly my number one strategy, without which I wouldn't even trade the market. I wouldn't even think about trading the market, probably, because I use, and it's gaps, and I use gaps in my day trading, in scalping, in my swing trading. 56 to 57% of all my swing trades actually are off of gaps. It's not the day of the gap, but a couple days later is when my setup triggers, and that accounts for 56, 57%, different from year to year, but 56 to 57% of all my swing trades are off of gaps. And almost 100% of my day trades are based on gaps. So it's truly my number one strategy. And I would love to go over it with you, show you what it's all about, and take your questions. How about that? Shall we? And then there's also an amazing offer at the end of the webinar, so make sure to stick around. First, let's start off nice and easy. What you will learn in tonight's presentation. The 80-20 rule, okay? Which isn't all that important, but basically 20% of the trades account for 80% for 100% of the result, for 80% of the result. My number one gap strategy, we'll go over that. We'll go over why it's my number one strategy, but I'll also show you how to trade it. And that special offer that we talked about, okay? So stick around, please. Okay, so there's this thing called the Pareto principle, or the 80-20 rule. Pareto was an Italian mathematician who observed that 80% of Italy's wealth belonged to 20% of the people. And he realized that a small number of people, inputs, drive most of the output. And that's how the 80-20 rule came about. You'll find this principle everywhere in life. 20% of a company's products usually drive 80% of the sales, 20% of the criminals commit 80% of the crimes. No stereotypes. It is true. 20% of drivers are in 80% of the accidents. Twitter cut 80% of its staff, and it's still running and doing okay. 5 NBA teams out of 30, so that's 15%, account for 63% of all the championships. There's 332 million US citizens, and 535 people in Congress cause 99% of the problems. There you go. 100 senators and 435 congressmen. So, all right, how does this apply to your trading? Well, the first hour of the day, which is 15% of the day, gives you 80% of the trading opportunities. To tell you the truth, to tell you the truth, the first even 30 minutes of the day, but let's say the first hour of the day, has been accounting for more than 100% of the money every day. How do I say that? Because I spend the rest of the day giving back money most days. Most days, the first 30 minutes, first 45 minutes, first hour is when I make all the money. And then the rest of the day, if I spend more time trading, I'm actually losing money. How about that? That's not the case all the time, but lately that has been the case, unfortunately, because it's been really slow after the open. Okay, it's just the way it is. But in general, it is true that you really only need to trade the open if you can master that gap strategy that I'm about to go over with you. So as I said, I do all kinds of trading, scalpings, scalping. I did the IQ short, India Q-tip, right? Check it out. That symbol. I did it short on the mic. Was amazing. That was a scalp trade and a gap trade all at once because we scalped it off the level 2. I do climactics. I called the market long off the bottom. That was really nice at lunch. I do earnings plays. We did what did we do yesterday? Earnings plays. We did the CSIQ short. Again, CSIQ, that solar stock short. We did the IQ short also as an earnings play last night. So today was those were nice today. We play breakouts, breakdowns, 1, 2, 3 plays, all kinds of plays. Okay, pullbacks, I don't know, shakeouts. But truly, the vast majority of my profits, if I look at my P&L, month in, month out, year in, year out, it always goes back to gaps. Everything else is like very little compared to gaps, to stocks that actually gap. Now, why is the open and why is gap trading in particular very lucrative? First, you have high liquidity, of course, at the open, but you also have high momentum, right? And we're going to talk about the reasons why we have high momentum. We're going to talk about that. And if you win early, you can do whatever you want. Sometimes I love being a teacher. That's always been my calling. I only discovered it after becoming a teacher. But it's always been my calling. I raised my brother since he was 13 years old. And now he's an adult. So it's always been my calling to be a teacher, to be kind of a father figure, so to speak. Okay, this is what I was going to say. I enjoy being a moderator and leading a room and teaching and all of that. But sometimes it costs me money because there's nothing to do after the open. And right now is one of those times. As the market has been grinding up, especially the last few days, it hasn't really been making any progress. So you trade gaps at the open and there's nothing else to do the rest of the day. Today is different because the market moved a lot. So there was a lot to do up until early afternoon, I would say. And then after that, there wasn't much to do. At any rate, so the smart trader focuses on winning the open. That's just the fact. I'm not trying to tell you that I'm a smart trader because I focus on the open. You draw your own conclusions. I'm not saying that exactly. So here we go. Phase. This is what I want to talk about. Really, is the gap strategy. Okay. So what is a gap? What is a gap? We know that all stocks gap every day. Almost every single stock gaps a little bit, a cent, 2 cents, 10 cents, right? Every day. But we're looking for significant gaps. We're looking for gaps that create kind of a hole in the chart. So a gap is a hole in the chart between yesterday's close, and today's open, with pre and post market data excluded, because most people don't trade the pre and the post market, so we discard it. I'm not saying there's no value in it at all, but for gap trading, we discard it completely, disregard it. Let's put it that way. Reasons vary. Sometimes, most of the time, because of news that affect the company or the stock, but could sometimes be due to sector news, market volatility, whatever it is, right? Here's what a gap looks like most of the time. You look at the chart and, okay, you see a lot of little gaps here and there. And in this stock, there wasn't, I don't see a single gap almost, but you get my point. You see a little gap here, just a little bit, but a significant gap, it stands out because it's like, wow, what is this black hole in the chart, right? And some gaps are absolutely devastating. Here's what I mean. You see what happened that day? This was four or 5 days ago on TSBX. I've never heard of TSBX before. It's rare when I come across a stock that I've never heard of before, because I've been trading for so long, half of my life basically, almost, that I've come across almost every single stock out there. Sometimes new symbols, new companies come about, or or new tickers, symbols change, stocks change tickers. And sometimes I come across a stock that's normally very thin, which is why I've never seen it before. This is one such stock. It's normally very thin. Look how much volume it did that day, by the way. Over 5-6 million shares. Take a look. See it? That day, normally it does maybe 100K. I mean, it normally doesn't do any volume, right? Very little. But this gap was devastating because it took out all of that in one fell swoop, in one day. So that tells us that every single person that bought it since October of 2023, so not quite a year ago, but almost. So for 9 months, every single person that bought it and held on to it woke up and they were now sitting on a big loss. Finally, every single person that had a stop in the system, it probably triggered that morning. So it was a really good idea to actually short the stock. I know it's a little stock. I'm just using it as an example. I don't necessarily gravitate towards the small cap, small stocks. I don't care what the price is. I do care because sometimes the expensive stocks, unless they're really liquid, they tend to be spready and whippy. And the small low price stocks are good if they're highly liquid, because you can scalp them off the level 2, like we did in the room today with the LU and the IQ. LU and IQ, both Chinese stocks. So this was devastating, but not every gap is going to be devastating like this. Sometimes it's okay. It's pretty bearish, like the gap we saw a month ago or so in Tesla. That was pretty bearish, gapped under a base, but this was not a tight base. So here's something to know. Gaps that produce really good follow through come from tight patterns. So if you have a tight base and then you gap under it, the stock tends to fall really hard, tends to produce follow through. If the base or whatever pattern that the stock gaps under or above is sloppy, then it doesn't necessarily produce a lot of follow through. So did it work that day? Of course it did. It worked. It was a good gap into a tradable void below, no support, right? So, but not every gap is going to look like the other one, the TSBX. A lot of times they're going to look like this. And how do you evaluate it? I'm going to go over that with you, how to evaluate it, how to figure out whether it's good or not good. And then this was a novice gap, which I played. I don't remember if I traded the Tesla short that day. I honestly don't remember. This one I did. And today I got killed on Tesla a little bit. That was actually my worst position. I'm in it as a swing position, but this came in today. And this was a good day to buy it. And we'll go over it in more detail later on. So this was a pro gap. That was a novice gap that day. Novice gap, you want to fade, you want to go against, or you don't want to if you don't want to trade, that's fine, because they're a little more difficult. Pro gap, you want to go with or trade in the same direction. My big aha moment happened when I realized that gaps compress time, and what that means is they generate, oftentimes they generate a 5 to 10 day move in 30 minutes or less, is what when I realized that. Then I started to not trade the same stocks every day. Almost everybody that starts out trading, I think, focuses on a certain number of stocks, like a watch list, maybe the Mag 7, right? Apple, Microsoft, Amazon, Nvidia, Tesla, and Meta. Or they focus on a couple of gold stocks, a couple of oil stocks, maybe a couple of high-tech stocks. So they get to know how these stocks trade, and that's all they focus on. Well, guess what? That's how I started in the beginning too. There were a few favorites of mine, and that's what I focused on. But most days I was, I was frustrated because they wouldn't move. Even when the market moved, they didn't move like I wanted them to move. And so that's when I discovered, and shortly after that, 4 months later, after I started trading full-time, I discovered gaps. And I discovered that, my goodness, I don't need to know anything about the stock, what the company does or what they do or anything like that. All I need to know is how to interpret the gap. That's all I need to do, is to be able to interpret the psychology of the traders that are stuck in the stock. And if I'm able to interpret it, then I'm almost guaranteed to get a 5-day move in 30 minutes or less, and assuming it's a good gap. Okay. So that's, that was a big aha moment for me many, many years ago. So you get more movement in less time. And isn't that what trading is all about? Getting like the best bang for your buck? Isn't it really? We all have limited amount of time to make money, to live life. So you want to get the most for the least amount of time. And that's really, truly why gaps is my number one profit center. In addition to that, gaps possess magnetic qualities. What does that mean, magnetic qualities? Well, first, they provide us with emotional shock value, right? Big gaps, especially significant gaps, shock traders into a state of fear. They wake up and maybe they were up on the stock. They've been up on it for the TSVX. Remember, maybe the people were up on it for the last year or so, 9 months, and then they wake up and they're down 20,000, down 15,000, down however much, right? And so they're shocked. They're like, "What happened?" Right? Didn't you used to Google the news right away? I used to. What's going on with the stock? What happened? Right? So they get shocked, and they feel, and worse than that, they feel trapped. They feel trapped. And so when you're feeling trapped, I mean, what do? You just start, you get desperate. So when enough people feel trapped, actually, that creates a stampede. Right? That's what creates stampedes. They start rushing, and they don't care. They're stepping on other people as long as they save themselves, right? And the same in trading. Unfortunately, it's the same in trading. So they wake up and they see they're down a lot. They get out. As they get out, the stock drops. As it drops, more and more people, their losses get bigger. So more and more people start to get out. As they get out, the ones that are still in it are getting hurt even more. They get out, and it starts that snowball effect, right? As a trader, I don't mean to be or to sound like I'm cold-hearted or anything like that. Sure, I feel bad for these people, but as a trader, you take advantage of it. You go short or you go long. Doesn't matter really. So you take advantage of that emotional shock. Okay, that's what we do. So these traders feel trapped, and they start acting or trading on emotions. Okay, out of that, based on that feeling of being trapped, rather than logic. And so we capitalize as traders. The other quality that gaps give us, that I don't know that I can do the same with any other type of strategy, is focus. I can look. This is today's gaps list. Okay, this is the gaps list that was posted in the room today. No, I didn't make any changes or anything. In fact, I posted this right when I posted it in the room. So with gaps, I can focus on just 2 or 3. In this case, okay, a little bit, that's 7 actually. Okay, 7 trades. But you see what I do? I first compile the complete gaps list with all the symbols sorted alphabetically. Now, that doesn't mean I put every stock that's gapping even a tiny bit on my gaps list. No, these are actually all the gaps that are worth watching. But I know that everybody has limited real estate space, right? We don't have unlimited amount of charts. So we can't possibly watch 200 gaps. In this case, there wasn't 200. There was maybe like 80 between the gap ups and the gap downs. Let's say 80 or 70. But okay, so these are the significant gaps. These are all the significant gaps that I found. This is the trimmed list. These are the best of the best, okay? And these are the favorites. Now, they don't always pan out. Like the ZUO was up at some point. I played it this morning, was up a good amount, was up $600, $700, ended up trailing it break even. And then the other ones I didn't even end up playing because they didn't set up right. The Snowflake was the one that I missed out on today because it popped. And so I was watching it for a short. I was talking about it on the mic. I was watching it for a breakdown, but it popped and I took my eyes off of it. And then I saw that it was breaking down. I started to tell the room, hey, the Snowflake is breaking down. And then it was gone. It was like too quick. So I missed out on it. But this is with gaps, I'm able to narrow the list down. So I start with the complete list, then I trim it down to a manageable amount, and then I trim it down more to the favorites. And those are kind of going to be my focus that morning. Sometimes I will end up playing something that's not on the favorites list, like the Peloton today or whatever, right? That was phenomenal. Wasn't on the favorites list, or the IQ wasn't on the favorites list. The LU wasn't on the favorites list, but ended up doing, and the IQ was a home run at the Open. But you see how it allows me to refine, to focus. So I start with the complete list, trim it down, and then go to the favorites. And then I also list the unique gaps, the secondaries, the ex-dividend gaps, the spin-offs, the buyouts, the splits, and the reverse splits. Those are unique gaps. They're different. Each means something. If you're not familiar with gaps, it would take me a minute to explain what each is. But those are like, if you don't know what they are, stay away kind of thing, okay? All right. Versatility. You can trade gaps as a day trader. You can do so as a swing trader. I told you the absolute truth. Over 50% of all my swing trades originate from the gaps list. So what I do is, as a swing trader, I save the gaps list every day. And I save it in an Excel spreadsheet. And I look at it not today after the close, but tomorrow after the close. That's when I start looking for swing setups off of the gaps list. So as a day trader, it's my number one thing. As a swing trader, it's my number one thing. For scalping, it's my number one thing. Some traders, not going to say who, make their entire living trading gaps. All right? So how does this help you? Well, now you know where the money is. Gapping stocks create an instant watch list of opportunities. You don't need to even scan the night before. You don't need to watch something like a hawk. If it's a good gap, you can watch it. And every day you start off with a fresh new list. You don't have to focus on the stock that really hurt you badly the previous day or the last week and try and get revenge and revenge trade it. None of that. Every day is a new list. Beautiful. Love it. So fresh, new every day. You save time. You ignore 95% of the stocks, 99% of the stocks that are not moving right now, right here, right? You enjoy the endless opportunities. Even in a boring market, dozens of stocks gap every day, meaning thousands of opportunities every year. And that happens even outside of earnings season. Like throughout the whole year, every single day, there's gapping stocks. I can't say the same about any other strategy that I do. Some days I can't find stocks to play that go climactic, to play as a climactic buy setup or sell setup. I can't find good breakouts. I can't find good level 2 scalp plays. But every single day, I can find stocks that gap every single day because there's news every day. So now you know the why I trade gaps. Let's talk about the how, okay, which is just as important. You always want to know the why, by the way, first, then the how. The why, that's actually maybe even more important, because if the why is not interesting enough to you, then why would you want to know how? You wouldn't want to know the how, right? But if the why is interesting, why trade gaps, right? Why I focus on gaps, then let's see how we trade them, okay? So there's primarily two types of gaps. There's a couple of other classifications, just a couple more, but there's primarily two types of gaps: novice gaps, amateur gaps, rookie gaps, whatever you want to call them. These are the gaps that are that happen on stocks that are usually up a lot and then gap up and they end up selling off. My best trade today was the Qs short. I've been riding the TQQ long. 2 days ago, I sold 2,000 shares, and today I got out of 1,000, made like 63K. Not going, that was amazing. One of my best trades this year. The TQQ off the bottom, which happened like 3 weeks ago. But I also flipped the Qs short today, which was my best trade. Why? I treated it like a novice gap, even though it didn't exactly meet the criteria as a novice gap. Now, you might think I'm making this up. If you're in the room, I'm not making anything up. This is the absolute truth. So novice gaps are happen on stocks, could be on the market too. We'll talk about them, that are up a lot and then they gap up. So it's the novice people finally, realizing, my gosh, I better get long because the market is going to make new all-time highs soon. And then they get long and then the market tanks because it's the last batch of buyers finally committing to the market. Finally, you decide to get long and it goes against you. Why? Because you've watched it go higher, 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 higher. And then when you could no longer take the pain of missing out, of not being in the market, you go long and it tops out. Now, initially in the beginning, I used to think, why does it seem to happen to me all the time, right? Because I was a novice trader for 2 years before I decided, okay, let's spend it cost me $8,000 to take the TPM class. $8,000, I'm not even kidding. It was actually $10,000, and I had to do some negotiating to get it down to 8. So for 2 years, I was a novice trader. And sometimes, honest to God, I would buy the stock at the absolute high. Like, how? How did I buy it at the absolute high or sell it at the absolute low? I'm not usually the only one doing that. It's basically when you can no longer take the pain of not being in the stock anymore. That's when you jump in it, and you're not the same. And everybody and the people that are sitting on the sidelines are feeling the same way. And we, as human beings, we have similar psychology and we have similar pain threshold. So when we finally decide to just do it, when you finally decide to just go get long, well, a bunch of other people are also making the same decision because they can no longer take the pain of not being in it. We have, again, similar threshold. So that's what lead to novice gaps failing, and then you play them short if it's a novice gap up. Okay, if it's a novice gap down, you want to play it long. We had one of the best novice gap downs in history a few weeks ago, and I'll talk about it later. We have the majority of the gaps. That's not the majority. That's like 10% of the gaps most days. 90% of the gaps, and my true focus most days, are pro gaps. These are the surprise gaps. The stock maybe is selling off or going sideways, and then some great news comes out and it gaps up and shoots up, right? Those are pro. Doesn't mean it's like it started by the pros. It just means it's a surprise gap. It's a gap that nobody expected. The novice gaps, you see the stock up, and then gaps up. That's like that. That's the novice people chasing it, basically, the FOMO people chasing it. Pro gaps are, the stock is breaking down and then gaps up the next day. Surprise, it catches people off guard. It's the opposite of what most people were expecting. Now, I'll teach you how to find the most powerful gaps. These are called tier 1 pro gaps, or A rated, right? You know how A, B, C, those are A plus rated gaps. So here's the checklist for a tier 1 pro gap. On the daily chart, we use the daily chart for analyzing gaps. The stock needs to gap just above all nearby resistance. Okay, so these are the two important words: just above, not too far above, but not below either. You want to clear resistance and not clear it by a lot. You want the stock to gap just enough to clear resistance. Okay, just enough to trigger the stops. You want the stock to gap above a wide range red bar from the prior day on the daily chart. One wide range red bar, two wide range red bars, or as the more the better. Basically, the more red bars, the more shock value. Basically, okay. So we want the stock to gap to create shock value, right? To go against the message that the stock was telling the world the day before. It was breaking down, and then the next day gaps up. You want the stock to ideally change the long-term trend on the daily chart. So if it's sideways, we want it to gap up or down would work. Either way would work. If it's downtrending, we would like to see it gap up against the trend, break the long-term downtrend. So that creates shock value in the long term. And then when it gaps over a red bar, that's shock value in the short term. So that shocks. So point number two, shocks traders. Point number 3, shocks investors. So if we can get both, that's the best. If you can get both. And then we also want the stock to be showing relative strength. That's the easiest point to evaluate. Basically, we want the stock to be gapping on its own page, not due to the market. Or if it's due to the market, we want it to be gapping a lot more. The Qs, the NASDAQ, and the S&P 500 a few weeks ago when we bottomed, I think on August 2nd, actually. So yeah, it's been about 3 weeks. We're both gapping down about 4%, 4 to 5%. Some stocks were gapping down 15. So that's relative weakness. So again, we want, most of the time, you want the stock to be gapping on its own page. So the news is only relevant to that stock, right? It's not gapping because of the market. But if it is gapping because of the market, we want it to be gapping a lot more than the market, okay? Let's take a look at some examples. Here's an example for you where the stock, the day before the gap, this is the gap, see it? See the hole in the chart? That's the gap. The day before it gapped, the stock actually broke down on heavy volume too. And it closed at the lows, almost, not exactly at the low, but almost. That tells us that the people that went short stayed short. How do I know? Because if they had covered, the stock would have printed a bottoming tail. It would have been like this, right? Or, it would have been like that. It would have, we would have seen it rebound before the end of the day. But the fact that it closed at close to the lows tells me that most people that went short stayed short. So, and they had good reason to play it short because it was breaking down, right? The next day, you might say, well, not everybody goes short. People just sold their position. You would be right. Yes. And the people that sold their position, they're called the sold out bulls. The next day they wake up and they're like, oh my God, I better get back in it. So they get back in it and it goes higher. The shorts, they cover, it goes higher. The professional traders, they recognize what's happening and they buy it, adding fuel to the fire. It goes up again. So you have a lot of good reasons to play it. But here's the reason. Here's additional reasons. So there's a lot of shock value, but the fact that the stock was gapping just above resistance, cleared resistance. Okay, you might say, wait a second, this stock gapped from 1750 to, I don't know, to 1950. Isn't that too much? 12, 13%? No, it's not. The more the better, as long as it doesn't become too much. Like as long as it's gapping just above resistance, I don't care how much percentage wise. I don't care if it's 10%, 20%, 30%, as long as it's gapping just above resistance. If it ends up gapping up here to 24, it'd be too much, right? It would be too big. And then some people, the ones that are in it long, would probably get out of it. So that would counteract the short covering. And so the stock might not actually go anywhere. You have the profit taking and you have the short covering, wouldn't work, probably. But this stock was gapping just above resistance. Point number one is met. A wide range red bar the day before. Not only was it a wide range red bar, it was actually a breakdown bar. It took out the support. That's even better. And then the long-term down, this was in a long-term downtrend, and today the stock broke the long-term downtrend. Okay, if you draw a line, if you draw a trend line, this was clearly in a downtrend. Today the stock annihilated the downtrend. And assume it was showing relative strength because we don't know what the market did that day. But look, does the market ever gap 20%? The stock was gapping, 20%. So no, the market doesn't. So this was for sure relative strength. This kind of gap is what's known as, is what I call a tier 1 gap. That's like when you see this, close your eyes and buy it. Not really. I never play blind. I never trade blind. I always wait for a pattern. But this is the kind of thing that's almost money in the bank. Almost. This is pretty good too. Not as good maybe as the previous one, but almost. Broke down badly, and then the next day gaps up, clearing the resistance. You might say, well, wait a second, there's more resistance. Okay, the most important resistance to clear is the most recent resistance. So as long as it clears the most recent resistance, which is the top of that pivot or base, then it's good. Another thing to know is that when a stock gaps from being below the 20 to being above the 20, and the 20 is pointing up, it lifts it higher. So this is a perfect location for the stock to gap. If it had gapped here, I wouldn't have liked it maybe as much. It would still get the same tier rating, tier 1, as opposed to tier 2. But this was actually the ideal location. And notice it gapped to here and then immediately popped. If you didn't go get long right at the open or within a few seconds probably, it was gone. It never looked back. So gapped over resistance, gapped over a wide range breakdown bar, ended the short-term downtrend. This is, 3-week long downtrend, ended it, and assume it was showing relative strength. So it gets all the points. It's a tier 1 gap. That's beautiful. This is beautiful as well for the same reasons. Breakdown bar, gaps above it, just above resistance. You might say, wasn't there more resistance here? Yes, there was. Would I have liked it even more if there was absolutely nothing? Yes, I would have liked it even more. But I told you what's most important is to clear the most recent resistance. Do you think people from 2-3 months ago are still around trading today? Probably not. So it's not as relevant. It's not as important. So this gets also all 5 points, okay? Which is gapped just above resistance, that's point 1 and 2. Gapped over a wide range red bar, that's 3. Gapped over a longer term base, a month-long base, and then assume it was showing relative strength since we don't have the market. Now, you might say, okay, I got it. I understand what the stock needs to look like on the daily chart. How do I play it on the intraday? Well, there's various entry patterns that I teach. In fact, I teach 6 of them, 5 main ones, and then there's one more. But so at least 5 entry patterns. Here's 2 of them. The first one is called the buy setup pattern, where you get 3 or more. In this case, 4. Doesn't have to be 4 or 3 or 5. Could be 3 or more lower highs or 3 or more red bars. Having both is better, is more potent. And then the stock takes out the last red bar's high. When it does, that's an entry. Where's the entry? Just above the last red bar's high. Where's the stop? Below the green bar's low or the red bar's low, whichever is lower. So entry right here, okay, stop right here. That's called a buy setup or a pullback pattern. A pullback pattern. This is especially useful when the stock gaps a little bit too much, when it's an oversized gap. It didn't gap just above resistance, it gapped way above. If that's the case, then I look for the stock to fade a little bit initially and play it long on a pullback. This is one of my favorite patterns for gap trading. It's not one of my favorite patterns for everything, but for the open, it is one of my favorite patterns. Where I missed the play at the open because it popped right away or I wasn't watching it, I always wait for the first 1 minute bar high to get taken out before I get long, usually, almost always. So sometimes the stock shoots up right at the open and I'm not in it. Well, guess what? You can look for the 1, 2, 3 breakout. Sometimes you get 2 doji bars. So this is doji, supposed to be a narrow range bar. So a wide range igniting bar, a narrow range resting bar, and then another igniting bar. And that's your trigger bar. That's called the 1, 2, 3 continuation play or breakout pattern. If you get 2 narrow range bars, then you have a 1, 2, 3, 4 pattern. The entry is over the high of both bars 1 or 2 and 2, whichever is higher. Then the stop is below bars 2 and 3, whichever is lower. So that was the entry above the red bar's high, and the stop was under the red bar's low because it was higher than the green bar's low. Okay, got it? That's another way to get long a gap at the open. So I gave you 2 out of 5, 6 really, patterns that I use for trading the open. And let's take a look at some recent gaps. In fact, every gap after this one is like from just a couple weeks ago. This stock, assume the stock was gapping to the blue line. How would you buy this stock? How would you rate it? Is it tier 1, tier 2? Tier 2 means it met 4 out of the 5 points. Tier 3 means it only got 3 out of the 5. Tier 1 means it got all 5 points. How would you rate it? Well, the first point is gapping just above resistance. That's 2 and 1. So location is perfect, and the size of the gap is perfect, right? Just above, and it cleared resistance. So it gets the point for gapping above resistance, right? Clearing resistance, and gets the point for the size. It's not oversized. Then it needs to gap over a wide range red bar. It gapped over 2 wide range red bars. That's even better. It gets point number 3. Point number 4 is ending the trend on the daily chart. The trend on the daily chart that day was sideways. So gapping above it, that ends the sideways trend. And then number 5, assume it was showing relative strength. Look how it played out. Amazing, isn't it? That's an EXT. All right, beautiful. Now this stock, would you play it? Assuming it gapped to the blue line. How would you rate it? Is it good? Is it gapping over wide range red bar? I don't know. What do you think? And the answer is no, it's not. So this is not a tier 1 gap, but check out how it played out that day. It's low price stock, did over 100 million shares, gap to like 60 cents, ended up going to 3.25. And the next day hit 4, almost 4. See it? Why? Why is that? Doesn't get all the points. It didn't get the point for gapping over wide range red bar, right? It got the point for gapping above resistance and not too far above it, and assume that it got the point for relative strength. So why did it perform as well? Because it gapped over such a tight base for such a long time. It was in a very, very tight base. So when it gapped, it just exploded. So that's why it was point number 3 was so good that it didn't matter that it didn't gap over a wide range red bar. It still went way, way up. So grading or rating the gaps is important, but it's like riding your those training wheels is what they're called, right? You can do without also. After a while, you think I do the criteria in my head. Did it gap over resistance? Did it gap just above it? Did it gap over red bar? Did it end the long-term trend on the daily chart? Is it showing relative strength? I don't do that. I just look at the picture and I know what kind of a gap I'm dealing with, at least most of the time. Sometimes they don't play out like I expected them to, but most of the time I look at it and I can tell what kind of a beast I'm dealing with. Okay, and that's where you want to be initially. Yes, it's a good idea to print out a checklist and make sure that the gaps that you are calling your favorites or whatever, meet the criteria, but after a while you just look at the picture and you know what kind of a gap it is. Okay, this is from August 8th, I think August 8th. FTNT gap to about 66 or so. How would you rate it? Is it good, bad, tier 1, tier 2, tier 3? Would you play it? And here's how it played out. Amazing, isn't it? This one played out even better than I expected. But I thought it was a very powerful gap. Because in this case, it didn't just like gap over resistance. It gapped over so many pivots, 1, 2, 3, 4, gapped just above resistance. It was like unbelievable. It was really, really strong. It didn't gap over a wide range red bar, but like I said, didn't matter. This is as of yesterday, I think, is when I took these pictures. So this is, I don't know what it did today, but this is, as of yesterday. Look at it. Amazing. This is as of yesterday. This is the U. How would you rate this gap? Is it good? Is it bad? Do you like it? Do you not like it? Is it tier 1, tier 2? Would you play it? Here's how it played out. I know it was surprisingly good, but this was a special gap. It reported earnings and it did a secondary offering. Now, if you don't know what a secondary offering is, it's when a company issues more shares. They sell their own stock to raise money. So when the company first goes public, it's called an initial public offering, the first public offering, but they don't sell the whole company. They sell a portion of it and then they hold on to the rest of it. When they want to raise more funds later on, they can issue more shares or sell more shares, and that's called a secondary public offering or secondary offering. That's usually bearish. When a stock does an offering, and like 99% of the time, the stock will gap down because it dilutes stockholders' current equity. Okay, and it's not a good sign that the company needs money, right? Have you ever heard of Apple doing a secondary, or Google or Microsoft? They don't need money because they're really good, strong stocks. So when a stock does a secondary and the stock gaps up, that is like a super bullish sign. So this stock reported earnings that day, but it also issued a secondary. And so this was a special gap. It's extremely rare when a secondary offering gaps up. So if you didn't know the news, yeah, this one would have been a little bit hard to read because it gapped after a green bar. But it met all the other criteria otherwise, right? It did gap in a long-term uptrend, but it also ended this short-term downtrend. So, it met, I would say, 4 out of 5 of the criteria, at least 3.5, because long-term uptrend, not long-term downtrend. But look, it gapped over all of this. So, it was good, but if you knew the news, it was even better. Now, what about the pale? August 6th, I guess, or 7th. And then, the gap was maybe 2 days later, so 9th. That's the gap. How do you like this one? You like it, don't like it? Here's how it played out. Amazing, right? Yes, it is, because again, it's a special type of gap. This is called an island reversal. It's really, really bullish, even though it doesn't get all the criteria. It gapped to resistance. It didn't gap over a wide range red bar. Sure, it ended the long-term sideways trend. It was showing relative strength, but this is an island reversal gap. So it's a very, very bullish type of gap. Okay, we can talk about that in more detail some other time, but I'm going to keep going here. Then there's the checklist for the novice gaps, the other type of gap. And novice gaps are the opposite of professional gaps. Professional gaps are surprise type of gaps. You're not traders are not expecting it. You're not expecting the stock to gap up. Novice gaps, it's the opposite. It's like up, and then the stock gaps up. That's like totally novice. It's like when Tesla showcased the Model 3 car. It was up for a whole month, literally like almost every day up for a month. And then they finally showcased the car and everybody was like, wow, that's a nice car. Okay. And was very well received. And yet the stock sold off really hard. Why? Because people in the know had already bought the stock. For a whole month they've been buying it. The people that bought it once the car was unveiled, was shown on stage, that's the novice people that are waiting for confirmation before they get long. And so it's the opposite of a professional gap. But it's also the opposite not just in terms of psychology, but in terms of the picture. So for a professional gap, we want the stock to gap over resistance. For a novice gap, we want it to gap into resistance, not over resistance. For a professional gap, we want it to gap above a wide range red bar. For a novice gap, we want it to come from a wide range green bar the day before. So it was already being bought, right? For a professional gap, we want the stock to not be over, like not be extended. We don't want it to be gapping up after a long-term uptrend. We want it to ideally be gapping after a downtrend or a sideways trend and then gapping up. For a novice gap, we want the stock to be running up and extended and then a gap up. You see what I mean? So in the same direction as opposed to against the long-term trend. For a professional gap, we don't want it. We want it to have relative strength. We want it to be gapping a lot more than the market. We want it to, most of the time, want it to be gapping on its own, not because of the market. For a novice gap, we want it to be gapping in the same direction as the market. So meaning the market is actually contributing to the noviceness of the gap. It's not special. It's weak, but it's you don't know it's weak because the market is so bullish. So we want it to not have relative strength to the market. Okay. So for these gaps, you want to place short if it's a novice gap up. Okay. Or if it's a novice gap down, it'd be gapping into support, gapping down after a wide range red bar, gapping down after an extended down move on the daily chart. And we would want it to have relative weakness, not have relative weakness. We want it to have relative weakness. See, I got it confused too. So let's take a look at some examples. This is Tesla actually. So down 2 days in a row into a ton of support. This is where it broke out from. Went up like 80% in 10 days, 40%, sorry. 40% in 10 days, and then right back down to that area. Anybody that missed out that day got the chance to get back in it at the same price. And anybody that missed out on the breakout, I mean, take a look. So that's a beautiful novice gap. Boom. Right? So into support from a wide range red bar, two of them. From an extended down move far from the 20. This is the blue line. I should have said it earlier, but it's right here. The blue line is the 20 period moving average, simple moving average. The 200 is the red line is the 200. And it had relative weakness compared to the market. It was gapping a lot more than the market. Okay, like 10% into a ton of support. That's a perfectly novice gap to buy long. How about this one? This is maybe my favorite from the gap downs recently. This is Robinhood. I love the Robinhood long-term as a long-term play. I'm in it still. Okay. From that day, I thought it was the 2nd, but maybe it was the 6th. Look at the size of the bars. Look at the size of the drop from 24 to 18 and then gaps down to 14 in like 2 weeks, 3 weeks at the most. That's a really nice novice gap. Boom. Look at the move. Amazing. So this is like a tier 1 novice gap. I've seen better, but this is a tier 1 novice gap. Look at the market that day. This is the IWM. Now, does it meet all the criteria? Is it gapping from a wide range red bar? No, it's not. But look at the IWM. Look at this. Look at the size of the gap. Look where it's gapping to into the 200, which acts as a floor into all that support. That's a great area to go long. That's a novice gap. Not only that, this is the Qs, the QQQ, which I played, the TQQ, right? Not only that, but the market in the last, I mean, I've been trading full time since April of 2007, so long time. Maybe excluding the month of March 2020, COVID, excluding maybe the Great Recession, the early part of the Great Recession, every single time the market gaps down 4 or 5% or more, every single time it gets bought. And in this case, the market was down so much. It was in the news, wasn't it? People were reaching out to me. Do we have a recession? I'm not kidding. That's when I told the room, we're not going to have a recession, because people are already reaching out to me. Recessions usually happen as a surprise. There's shock to the system that causes a recession. But if people are already, texting me, reaching out to me about whether this is, are we headed to a recession? Family members, friends, that means we're not, it's too obvious. There was no shock. Recessions again happen when there's shock to the system. So I told the room, if you're in the room, a lot of you are in the room, I'm sure, I said that we're not going to have a recession. Okay, this is the opposite. So this was actually a great buying opportunity. It really, really was amazing trade. Now, did I expect it to go through the 20, to go through this resistance area and keep going? And this, like I said, this picture was taken a couple of days ago or yesterday, as of yesterday or the day before, I'm not sure. So, and we continued higher for another day or two before today, before the sell. I expected it to get to the 20, sell off a little bit, and then continue higher because we have a weekly buy setup. But it powered through the declining 20. It powered through the resistance, which was amazing. This was one of my best trades this whole year, maybe the best. So this was the Qs buying it. And I only bought 3,000 shares of the TQQ. I didn't buy 5. I didn't buy 10. I didn't buy 20. I'm just saying, it's not like I bought so much, just 3,000. As of 2 days ago or yesterday was up 66K. I took 2,000 shares yesterday, and today I trailed out of the last 1,000. So anyways, this is the gap strategy. This is how powerful it is. You can do it. You can swing trade. You can actually find good long-term opportunities. Like, I'm willing to bet you whatever you want that this low is not going to get taken out anytime soon. Meaning you don't even have to get out. If you bought the market, you don't even have to get out. Now, I'm a trader. I tend to manage my plays, sometimes over-manage. But some plays I will not get out of unless I take a stop. Like this Robinhood, I'm not touching. I know. I mean, I am touching, but not I'm keeping some for sure. I'm willing to bet this will not get taken out at any time, but not in the next year or so. The same with the Qs. I'm willing to bet this will not get taken out this low. So you can, if you know how to read the gap, you can even catch long-term moves, swing trades, day trades, all kinds of plays. And it gives you an instant watches. You don't have to guess every day what to watch. Turn on CNBC or whatever. You can you have the gaps list, you're golden, you're set. So what is your goal with your trading? Do you want more of the same, or I hope you want something better? And if you do want something better, okay, if you want better results, let me pass the mic over so you can hear what we have to say about. We have an amazing offer, so check it out, Mike.
Okay, guys. All right. First of all, we're not going to let Sami get off that easily. So everybody, why don't you give Sami a score, on a scale of 1 to 10? How much did you like this lesson? Because he basically taught you a whole course on how to trade gaps, and he threw in a little bonus at the end with some of his favorite long-term ideas. So what do you guys give Sami as a score? I'm going to give Sami a solid 6 out of 10 for tonight. I think 6 out of 10 is more than fair. Now, Hillary gives Sami a 10.
What the heck?
Pat gives Sami a 10. Mary gives Sami a 10. Prop Girl says really good stuff, Sami. Yep, we got a lot of 10s. Sorry. Right. I have an attitude problem, Sami, so I apologize. But guys, okay, yeah. So let's talk about how you can take your trading to the next level. So reality is you could spend years losing money with trial and error in trying random things you find on YouTube or whatever, or you could just take a shortcut with Sami because you do not have to go it alone. So we can help you become a faster, smarter, and more profitable trader through full training in Sami's unique gap trading system. You just got a little sneak peek of it, but you can get the whole enchilada and save a whole bunch of money. Yep, and Tob says, amazing, good stuff. Doc Fleet said, my account went from 550K to now 2,000. That sounds pretty rough. You definitely need the class. If you went from 550,000 to 2,000, we definitely need you in the class. And Jose says, definitely a big time. Okay, all right, I'll stop babbling, I promise. Okay, so we're going to introduce you to Opening Rush Live, which is where Sami teaches you the whole gap trading system live. So it's 3+ hours of live training. It goes down September 21st. Full recordings and slides included. And of course, you can ask all the questions you want. And of course, you get a huge discount because you're out with us for over an hour on summer afternoon. You know, all these lazy people out there on vacation, we're going to forget about them. We don't need them. We don't want them. They miss out. But you guys are here, so we're going to give you extra special deal. So if you sign up right now, you don't have to pay $395. You can get the course for just $99 if you go to t3live.com/open. It saves you $296. Again, regular price is $395. You can get the whole thing for $99 today if you go to t3live.com/open, and this way you learn the entire system. So our friend Eric from North Carolina said the class paid for itself within the first hour of trading the next day. Obviously, we can't make promises like that. We can't make guarantees. The ideal situation is you fire up your screens on Monday, September 23rd, and you make some money because you'll be able to use Sami's method to find your own gap ideas. Steve from New York said he's knowledgeable, thorough, and honest. A 10 out of 10 rating. Eric from North Carolina says, opening rush helped me overcome FOMO, made me willing to wait for the best patterns, the best trades and known setups and patterns. Okay. Wendy said the class was very, very interactive. Sami encouraged participation, made sure the group understood before moving forward. Most online classes are not that way. Yes. And that's a huge benefit of doing a live class, because you can actually ask questions if you're confused about anything. And Sami will not stop until everybody is happy. Christopher from California said, Sami helped me understand how to identify favorable gaps and how to consider them bearish or bullish. Lisa, great question. Can you rewatch the lesson after it's over? Absolutely, yes. If you go to t3live.com/open, you buy the course, you get the full replay, so you don't have to be there live. And in fact, a lot of people don't even attend live courses. They just watch the replay because it's more convenient for them. Louise from Georgia says, I feel very lucky to have Sami as a teacher because he's so enthusiastic, was also clear and detailed. Ken from Texas says, you get a new money-making trading skill forever that will likely pay for itself the first week. Again, that is the goal. We want this thing to pay off for you as soon as possible. Our friend Tob says, thank you, Sami. We'll sign up. Awesome. Thank you for signing up. We really appreciate it. So, quick question. So, who should sign up? Obviously, if you want to make money from opening gaps without watching the market 24/7, that's the ideal person. If you don't want to be glued to the screens 24/7, this is a great way to trade, get better results in less time. Is this for day and swing traders? Both. You can use Sami's method on any time frame. So if you're a day trader, you can use it. If you're a swing trader, core trader, long-term investor, whatever, you can use the method on Sami's time frame. If you noticed before when Sami was talking about the Qs, and in stocks like Robinhood, he was using the gap method on very long time frames. So yes, you can use it on all time frames, even if you're a long-term investor. Stacy's asking, does this work on crypto as well? No, it does not work on crypto because crypto does not gap. Crypto runs 24/7, so crypto does not gap. Can I ask questions during the course? Of course, absolutely. Sami encourages full interaction. He answers everybody's questions, so everybody is happy. And most popular question is, what if I can't make the live session? Sign up anyway because you'll get the recording that Monday. Plus, and this is why I drive everybody at T3 crazy by offering these deals. So normally, to buy just the recorded version, it would cost you $295. So if you went to t3live.com and bought the recorded version, you would pay $295. But if you take this deal, it's just $99. So yes, $99 for the course, and and it saves you a ton of money. Hillary says, is this a course or live trading? So this is the course. So Sami teaches you how to trade. Doc Fleet says, does it have risk management? Of course, everything in life is about risk management. So guys, again, $395 regular price. You get a $296 instant rebate, and it's $99 for you today. t3live.com/open, t3live.com/open. So Doc Fleet, I'm not sure what you mean. You said you get singles. Can you clarify just so we make sure we're on the same page here? And we'll see what other questions we have. Okay, so here, good question. So Sami, can you start with a small account?
Of course. I mean, ideally, you want to start with a small account because You don't wanna go heavy when you're just learning. You wanna go small, and if the results are good, then you can scale up, not the other way around. So you do want to start with a small account.
Okay, so our friend Doc Fleet is asking another question. Do you show where to enter and exit? I think this is an obvious question, but we should just get this out there.
I like to keep that information to myself, to tell you the truth, but I do show anyway. I do show the entries and the exits. Okay.
Yeah, Sammy, he does teach. He does play with an open book. He will teach you everything. So Skip is asking. So Sammy, I don't know a ton about futures. Will this work with I don't know. Do futures gap? Does this work with futures?
Uh, Look, do they gap? Let me think. They do gap. Yes, they do gap. So it should work with futures. I've never traded futures, but it should work with futures. The other thing about gaps is that it's part of the market, like the market gaps, right? It's part of, so it's a good idea to learn it anyway, even if you didn't plan to trade the gap strategy. Even if you didn't plan to trade gaps, it's a good idea to learn the impact gaps create on price action. So it's a good idea. And at $99, for the course, I mean, that is like a no-brainer to me. Mike, you get 4 out of 10 for pricing it that low, but it's all right.
Yeah, listen, I am not afraid. I can take on all the haters, including you, Sammy. So this is Sammy. Me and Sammy, our relationship has been getting worse. I feel like this year, me and Sammy have had a lot of problems this year. We had a big argument over hedging. This is just it all over again. Me and Sammy, we are going to be enemies within a couple of months.
Except that I won that argument.
Yeah. Okay. Prop Girl is asking futures gap, but you have to use real time trading hours. It's instead of I believe this means extended hours. Okay, Sherpa is asking, what is included after the courses watched? Does this include ongoing alerts? No, we can work on bundles if you talk to Amber. If you email amber@t3live.com, she can help you with all that stuff. But this is just the course, so there's no subscription. You don't have to worry about any other charges. It's just the course. So if you want to learn, this is an amazing way to get started.
They get the PDF manual, right?
That's true. That's true. They get the PDF, they get the recordings, but this is the how-to. You get the how-to guide to how to trade gaps. And so we have Ian, Stacy, Alexander, and Lisa have already signed up, which is good to see. Love people joining our courses. Wrong slide. Okay, yep. Lisa says joined, excited. Okay, good question from our friend Doc Fleet, is one of our most prolific question askers. How long did it take you before you became profitable, Sammy?
It's a common, I mean, I get this question frequently, and I hesitate to give you the answer because I don't want to like discourage you, but I don't want to like, give you false hope. Because if you're just starting out and I told you that it took me really 2 years to become consistently profitable, you might say, oh, I got plenty of time. I can fool around. I don't have to give it my best right away. And if you've been trading for 3, 4, 5 years and you're still not profitable, you might think, what am I, dumber than everybody else? Why is it taking me that long? So how long it took me is truly, not useful information. But I'll tell you, it took me 2 years, I feel, to become really consistently profitable. Within 4 months, I was pretty good at reading charts. Like I felt comfortable with charts, and within 9 months or so, I felt proficient. Like there wasn't anything that I couldn't interpret almost. But did that translate into consistent profitability right away? It did not. It took me a while. Did I have the best trainers and mentors, and was the information easily available to us traders back in the day, 20 years ago, 17, 18 years ago? It wasn't. So, was I a little bit stressed out about it and wanting to really prove to myself and everybody else that I could do it in 6 months? That probably didn't help either. So the point is, some traders hit the ground running, literally. Like, I mean, I have a co-moderator in the room with me. His name is James Young. And within how many months? Within 5 months, he was already consistently profitable. Why? Because he did an in-person mentorship with me. He was really serious about it. And within 5 months, he became a moderator. I've never had that happen with anybody else. So he got it. He got it quickly and never looked back, ever. He does videos on YouTube. His name, you can look him up, James Rich Young. He's rich and he's young. And I've seen traders really hit the ground running. Like within 3 months, they're already really, really good. And I've seen traders struggle in the beginning, like I did as well. Everybody's journey is different. What is important is to give it your best and to be serious about it and see what happens. Maybe that's your calling. Maybe that's what you're meant to do. Maybe not. But if you don't give it your best, you will never know for sure. So it took me a couple of years, but it doesn't have to. It doesn't really have to take that long.
Okay. Pat H said, I actually did one of Sammy's courses before. Definitely a must buy. Thank you, Pat. We definitely appreciate it. Okay, Sammy. So can you talk a little, just making sure I'm scanning through the, so is your, gap trading, how is it mixed between shorts and longs?
50-50. I mean, I would say 50% of the plays, 50% of the, 50% of the trades that I take, 52% are short, 48.5 or so are long. So about 50-50. I play long and short, both directions. No preference, really.
Okay, yeah. So again, yeah. So remember, Sammy is a little different than a lot of the traders you may see in public, where he's literally just trading the charts. He doesn't care what the company, as long as it's not an ADR, I believe. Sammy really does not care what the company does. It's all just numbers on a screen.
It's just chart patterns. Whether it's long or short doesn't matter to me, basically.
Okay, guys. All right. Do you have any more questions? I'm going to give 30 seconds for, we have a whole bunch of people joining. I'm going to have 30 seconds until we close out because it is almost time for dinner, at least here on the East Coast. Okay. Going once. Going twice. And that's going to close us out. Again, guys, go to t3live.com/open. You could take the class for just $99. You save $296. It is an amazing way to learn and become a more successful trader. So, Sammy, thank you for coming out with us tonight. We always appreciate it.
All right, Mike. My pleasure. Thanks, guys.
Thank you, guys. And yes, we will send out the recording in just a little bit. So keep an eye on your inbox for the recording as well as special offers. Have a wonderful evening.